Hello everyone, this is the Naples Money Managers News You Can Use, and I am Marcus Bickle. I am by myself today, and this will be a short one. We're having a bit of a sideways market. We had a pretty robust CPI, which is the inflationary number, and that's tended to move the market sideways. And right now, we're kind of entering that point in the year where school's starting to come back. School started down here 2 weeks ago now, and after Labor Day up north, all the schools will be back. So generally during the summer, there's the idea of sell in May, go away. All the hedge fund managers head off to the Hamptons. Must be nice. And the markets are pretty quiet. But once the kids come back to school, everybody's back. So people start paying attention again. So we may be entering a period of higher volatility. We're watching that very, very closely, as well as realized gains, taxes. We're in our third quarter, folks, so before you know it, we will be at the end of the year. So we're already starting to take a look at that. If you have anything related to your yearly taxes that you think you would need us to know, please get it to us at your earliest possibility. That gives us a better, holistic outlook on what we need to do to make sure that your accounts don't have huge realized gains and losses for the year, because we are having a pretty decent year, folks. The last couple of days have been rough because of that CPI number, and the administration is kind of fighting with the Fed. So we'll see. They seem to go back and forth with that, and that kind of news tends to rattle the market a little bit. So right now, things are pretty flat. The tech sector in general has probably been the most beat up recently. The NVIDIAs, the Palantirs, but they were also the highest flyers this year. So this might just be people taking profits, a little bit of a correction based on news. But the economy does remain strong. But let's talk about that CPI number a little bit. So the CPI number, inflation, came in higher than expected. Not quite back to where we were during 2021, 2022, but definitely creeping up despite the monetary policy of the Fed. Now that's not particularly good because you have two forces here, folks. You have the administration on one side saying cut rates, it'll supercharge the economy. And then you have the Fed over here going, we can't cut rates. We cut rates, it'll supercharge inflation, because that's what happened in 2021 and 2022, folks. We had close to effectively zero interest rates. And because monetary policy was so lax, we had inflation. It's a really hard needle to thread. We don't want to go into recession by having rates too high, but we also don't want rates so low that, eggs are $15. I mean, I think they're still $9, but still waiting on those eggs to come down, but they haven't yet. So that's kind of all I have for you today, folks. It's not a lot in the market as we wait to see where inflation is going to head. But the thing you can take away from this is we are staying the course. The covered calls are very well protected, and we have a plan going into the end of the year. It just depends on where things head. That's all I have today, folks. Remember, money matters, but most importantly, you matter. Please like and subscribe, and I will see you next week.